Hey, what's up everybody? It is Thursday, December 9th. So stocks took a little breather today. Hey, listen, it could happen. I mean, people get scared. The slightest little thing happens and people get scared and people get nervous. I bought some tech stocks today on the pullback. You know, like I've been telling you guys, you use these pullbacks as buying opportunities. Fiscal flows are actually really strong. I mean, the 10-day average of daily flows right now are at 31.1 billion. That's strong. That's over a 600 billion monthly flow rate. And we made a new year-over-year high in the flows. They're up 113 billion year-over-year. That is a new high for this fiscal year compared to last fiscal year. So, I mean, if you look at a chart of the flows, it's just a nice 45-degree ascent. So that's good. So I use the, stocks are on sale when they go down. So I get some. Hey, today, did you see weekly unemployment claims drop to the lowest level since 1968? So what's that? 53 years. The lowest level in 53 years. And I track the daily flows, unemployment benefits flows. That gives me like a leading indicator, and that has been saying all along that, the labor market is strong. And I mentioned the other day, yesterday, I went out a couple of days ago for my girlfriend's birthday. I mean, it is packed here. It is packed here in New York City. People are out. People are spending money. Corporate profits are strong. I know I sound like a broken record, and some people don't like good news. I mean, some people want it to be doom and gloom. People make entire industries out of selling doom and gloom. There are a lot of guys out there like that that's constantly their focus, and there's a lot of people that they just want to believe in that. Now, I'm not saying everything is fantastic, but economically, you can see how the fiscal support, it just continues to keep things supported, and that's going to continue to be the case. Now, we still have, the Fed worries, the inflation worries, the taper. They're going to taper. They're going to take away the punch bowl. We got those worries tomorrow. We're going to get the CPI. It's going to be a high number. Everyone's going to freak out because the Fed is going to speed up their taper. And I explained to you many times already what this taper is all about. I mean, really what I want you guys to do is just ignore the central bank, ignore the Fed, ignore monetary policy, and stay focused here with me on fiscal. And you'll be on the right side of, basic conditions. What else can I tell you? I mean, I'm trying to give you some really good advice here. Everybody is so tunnel vision focused on the Fed and these just inconsequential policy shifts that they do. It would be one thing if we were talking about they're raising rates, 2-3% at a clip, or even 1% at a clip, and we're up at 13, 14, 15, 20%. We're at 0 to 25 basis points. They're slowing up their asset purchases, which, as I've explained so many times, that is a positive thing for the economy. That's just going to redirect interest income flows into the economy, as opposed to that income going to the Fed, going nowhere. Basically a black hole where the Fed just turns around and gives the money right back to the Treasury. It's also going to help to slow down the growth in reserve balances. And I did a lot of videos on how reserves constrain lending. Now, most people out there think of it in the wrong way, or they understand it backward. They think that when the Fed pumps in that money that the banks lend it out. They don't lend it out. They might lend it out to each other on an overnight basis, but they don't lend it out. They can't lend it out. It doesn't, you know, it just would go from one bank's balance sheet to another bank's balance sheet. All right? So, and when the Fed is buying all these assets and pumping reserves onto bank balance sheets, reserves are bank assets, they have to have capital to account for the addition of those assets. They'd rather have loans. Loans pay them way more money than, you know, reserves. So, I mean, they don't need the reserves. We are well above, what is it, like, I think we're like somewhere around 16 trillion in deposits. So what, they need 10% of that, so they need 1.6 trillion in reserves. And we're at like 4.5 trillion or something like that. So like we are so far above what is required that it is a hindrance. It is a hindrance for the banks. By the way, I'm just going to let everybody know, if it sounds like recently I'm speaking with a lisp a little bit, I got these aligners. All right? My teeth were crooked. I've been thinking about getting them for a long time, so I got these Invisalign. You could hardly see them. And so I'll be having these for a while. I straighten my teeth out. Anyway, folks, that's what's going on. Buy the dips. Tomorrow, maybe get some more dip. If the CPI comes in hot, then everyone's going to freak out. And even if the CPI comes in a little bit cooler, it's not going to stop the Fed. And by the way, the Fed meeting is next week, and they're going to say, hey, we're going to speed up the taper, and the whole shebang is going to start all over again. We'll get a correction on the Fed. You know, the dollar's going to go up. Bonds are going to sell off. The whole gold's going to go down. But that just, it gives you an opportunity in all of those things when that happens. Those are moves. Those are reactions. Those are emotional reactions that you have to go against. All right, that's it for today, folks. See you tomorrow. Bye-bye.